Good morning, everyone. Welcome. I'm trying to give it a few minutes for everyone to start logging in. We are nice and prompt. I'll see if everyone's joined in so far.
Do we start promptly or will we give it another few minutes?
Let's give it a couple of minutes. We can start, maybe you want to give it a minute and then we'll start doing the introductions to Claire and then we'll start our presentation. People can catch up on the YouTube link if the need be.
So you want to start straight away?
I think so. I'm sure everyone's got a busy day ahead.
Okay, so welcome everybody and especially welcome to Claire Thompson from WITS Incorporated. And I hope everybody's got their coffee ready and that or maybe you're into your third cup of coffee as I am, and ready to go to just keep your wits about you. And sorry about the pun. And then we'll start. If anybody joins, I'll have to catch up. So Claire, that's all yours. Enlighten us about wills.
Thanks so much for having me today. It's really such a pleasure to be with you and your delegates today. I think many people probably who've joined today will know already that September was Wills Month. And I think that was what prompted a discussion about possibly doing or having a chat today about wills and the legal aspects of that. I am here today to talk about the legal aspects, and the financial aspects will be dealt with by another presenter later on. So those are not aspects that I'm going to be touching on, but I am going to be talking about the legal aspects. And we will have a little bit of time for questions at the end. So if it is that you do have something that you would like to ask me, there will be some time before we close off. So I think very often the question is asked, why should we have a will? And I think a lot is said about how important it is to die with a will. And to have a will prepared in order to ensure that your family and that your heirs are protected after one's death. And And I think it's the basis upon which we start this conversation. I think from a personal, anecdotal perspective, I lost my dad last year in January. And I really personally understand now why it is that a will can have such a significant impact in a family's life. Even if it's a simple will that makes provisions for what is ordinarily contained in the Intestate Succession Act, even, which is something that we will discuss in due course, I think it's really important to consider what you would like to happen in the event of your death. And we work so hard throughout our lives to build up an asset base, to ensure that our family are well looked after, both before our death and afterwards. And I think it's important to put together a will that caters for your particular needs and your family's particular needs. And every family is unique. Every family is differently set up. And I think a will can give cognizance to that and give recognition to the unique structures within that particular family. So if it is that you die without a will, the Intestate Succession Act tells us how your estate is going to devolve. And I'll go through some of the basics with you in the next slide. If it is that you decide that you would like to prepare a will, you then disclose in that document how it is that you would like your estate to be divided and how you would like your children to be looked after in the event that you have children under the age of 18. And possibly even if you have dependent children who are adults, you can deal with all of these aspects in your will. A question that I very often get asked is about liabilities. And it's important to bear in mind that the general principle is that liabilities cannot be bequeathed and they cannot be inherited. Now, I think it's important to consider that if it is that you sign a surety, or if you are a co-principal debtor, or if you are the co-holder of the liability, and if we consider a bond, for example, if both parties are responsible for the bond, even though one party dies, it doesn't absolve the other person of responsibility. And so it's really important to bear in mind that the general principle is that liabilities cannot be bequeathed, but under certain circumstances, because of the nature of the contract in which the liability arises, there could be a liability that remains for people that are left behind. Now, if it is that we consider what intestate succession looks like, again, this means that you die without a will. And really importantly, what I want everybody to bear in mind, and perhaps if there is only one thing that you take out of this presentation and that you share with your friends and family, is that if you don't have a will, the state is not going to assume responsibility or ownership of your estate. It is a very, very rare occasion that there are absolutely no heirs in someone's family. And if it is the case that there is absolutely no one who would be ordinarily entitled to inherit one's estate, that estate would vest with the master of the High Court for a period of at least 20 years prior to those assets being forfeited, so to speak, to the state. So dying without a will does not place your heirs at risk of losing your assets to the state. And so I think that that is particularly important to bear in mind. And a very well-respected colleague of mine often says, one always dies with a will. You either die with a will that you prepare, or you die with a will that the state prepares. And a will that the state prepares is in fact contained in the law of intestate succession. So I'll go through the images that you can see on the screen. The first, I will go down to the bottom left-hand side of the screen where it's written unmarried with parents. So in the event that you have no children and you have no spouse and you have parents, possibly even siblings, if it is that you were to die and you were to leave two parents behind, your parents would inherit in equal share. And if it is that one of your parents were to die, then your parent that survived would be entitled to inherit the balance of your estate. Now, if we go over to the right where it says spouses, if it is that you are married and you have no children, your spouse will inherit 100% of your estate. And this is one of the invariable consequences of marriage. So if it is that you choose to get married and you die without a will, your spouse will inherit 100% of your estate unless it is that you prepare a will that discloses something else. So if it is that you did, for example, want to benefit a sibling, or if you want to benefit your parents, if it is that you are married, you would have to prepare a will in order to deviate from what the law provides for you. Now, if we take another step to the right, where it says spouses and kids, if it is that you die and you have a spouse and you also have children, your spouse will inherit either 250,000 Rand or a child's share. But the determination of whether or not they will inherit a child's share is determined by whether or not that child's share is greater than 250,000 Rand. Now, the way that we calculate a child's share is to determine how many children there are that are born of that person who is deceased. Now, if it is that we look at the yellow block and we assume that that person is the deceased, then we would calculate a child's share by dividing that estate by 3. And the reason for that is because the yellow block is married to the blue block, and there are 2 children, which are the orange blocks, that are born from that marriage. The blue block has a green block, which is another child which is born outside of the marriage. So if the yellow block is to die and leave a spouse and 2 children, we calculate a child share by dividing yellow block's estate by 3. And if that amount is greater than 250,000 Rand, then the blue block and the 2 orange blocks will inherit equally with one another. Now, if it is that the yellow block's estate is worth less than 250,000 Rand, or only 250,000 Rand, or if we divide that estate by 3 and the number is less than 250, then the blue block inherits the first 250,000 Rand, and then the orange blocks, the children in this case, will inherit the balance of that estate in equal share. Now, if it is that we were to look at the blue block and say that the blue block was to have died and not the yellow block, in that case, we will calculate a child's share by dividing the estate into 4. The reason for that is because we have 1 child born outside of the marriage, 2 children born in the marriage, and the yellow block being the spouse. If it is that you have questions about this and there is any uncertainty that you have in your mind about how these calculations are done, you're more than welcome to set up some time with me so that we can discuss this in greater detail. Now, the last block, which is at the top right-hand side, is unmarried with children. Now, if you die and you are either single or you are divorced and you leave children, your children will inherit an equal share depending on what the value of your estate is. There is absolutely no share to anybody else other than your children in that case. So if we move on to talk about drafting a will to vary what it is that the law provides in the law of intestate succession, the question I very often get asked is, can I draft my own will? And the answer to that is absolutely yes. You can even sit at a restaurant this evening and on a serviette draft your own will in handwriting if you so chose. And so long as it met the formalities that I'm going to discuss with you now, that will be a valid will, even if it is written on a serviette. Now, it's not something that I would recommend, and I think it's best to have good consideration for what exactly you're going to put in your will and making sure that the document is well prepared and that it's clear. But the the requirements, at least, are as follows. You must be over the age of 16 years in order to create a will. So I think probably most people in this room would be considered old enough. Perhaps if you are with your children, if your children have joined you today, if your child is over the age of 16 years, they can create a will of their own. Now, very, very importantly, in 2022, your will must be in writing. So this means you can't leave a voice note to your family saying, this is my last will and testament. You can't create a video and store it on your computer and say that this is my last will and testament. There is no provision for the creation of a testamentary document or recording or anything like that that is not in writing. It is absolutely imperative that your will has to be in writing in order for it to be valid. Now, writing doesn't mean that you have to handwrite it in order for it to be a valid will. It means that it has to be on a piece of paper, and it either must be handwritten or it must be typed. So please make sure that if it is that you are preparing your own will, that you adhere to these formalities in order for it to be valid. Otherwise, your estate will devolve in terms of the law of intestate succession, and then you will have missed the opportunity that you intended to create in drafting your will. Now, it's important that there is no blurring of lines, if I may say, in that a beneficiary, somebody who stands to benefit in terms of the will, must not write the will on behalf of the testator, and they also should not sign as a witness to that will. It's absolutely important that a beneficiary does not sign the will as a witness and does not write that will on the testator's behalf. Now, after the will has been drafted in either handwriting or typed, it must be signed by the testator and two witnesses at the end of the will. Now, importantly, at the end of the will means at the end of the last words that are on the page. So if it is that you have 2 or 3 lines on the final page, don't sign at the bottom of that page. Sign at the very end of the last word that is disclosed on that particular page. And both witnesses must sign and watch the testator sign their will. This is very, very important, because if there is any dispute as to the validity of the will, or if that testator actually signed, it's important that those two witnesses can come to court and testify that they in fact watched that testator sign that will on that particular day. And it's of utmost importance that this criteria is in fact satisfied. And what we very often do is we also get the witnesses to write out their personal details below their signatures when they sign at the bottom of the will. The witnesses must be over the age of 14 and must not be beneficiaries. I cannot overemphasize how important this is. If it is, and I will say more often than not, a will does comprise of more than 2 pages, even when it is typed. If it is that there is more than 1 page that the will consists of, the will must be signed in full at the end of the words, and then on every other page, there must appear 3 initials, one of the testator and one of each of the witnesses. And that must be done as close as possible to the end of the words on that particular page. Now, in law, we look at formal validity and we look at substantive validity. Now, formal validity speaks to what it looks like on the face of it. Is your will signed? Is it in writing? But a substantively valid will speaks about what is in the content of that will in order for it to be valid. And it's very important when drafting a will, either on behalf of a client or for yourself, that we make sure that we don't create conditions in that will that are either going to render it invalid or are going to create difficulties for family members who are going to be left behind after that deceased person has passed away. Now, first of all, and I think that this is perhaps more obvious than the others, is that you cannot create clauses which are illegal or against the good morals of society. And in the fullness of our history, there have been lots of changes about what constitutes good morals, for example. If it is, though, if I can use an example, you cannot create a clause in a will, for example, that was to cause somebody harm. So you cannot say, I will bequeath my estate to my son on the condition that he is to beat his sister every day for a year, for example. That would absolutely not be a valid condition, and I don't think it even bears much more consideration than that. I am using a very outlandish example, but you must bear in mind that anything that has an illegal condition to it would then not be legally valid and would not be enforceable. A clause which is intended to break down an existing marriage would also not be permitted. So an example of a clause like this would be, I bequeath my estate to my daughter on condition that she divorces her husband. This would not be a substantively valid condition in a will, and for the avoidance of any possibility that a will would be considered invalid as a result of a clause like this, don't include a clause like this, whether it be in your will or a will of a client. It's absolutely imperative that we don't include clauses that would create any sort of question as to validity. Now, finally, you cannot create a clause in a will that prohibits somebody from remarrying. So I bequeath my estate to my husband on the condition that he will never marry again. This is not a valid condition in a will. We do not want people to be able to rule from the grave, so to speak. So anything that substantively could put that will at risk is not a valid condition, and it should not be included in the will. And if it is that you are unsure whether a clause in your will or a will that you are drafting on behalf of a client is or isn't valid, please rather seek advice to ensure that you are not creating a will that is not enforceable. And if you are creating wills for your clients and they ask you to please include a clause like this, it is incumbent upon you to advise them that you cannot do so, because it is important for us as professionals, even if it is the case that we want to follow the directions of our clients, and even though we are aware of the fact that a will is ultimately a statement of intention of that deceased, we also have to advise people whether the will that we are drafting for them or they intend to draft for themselves is in fact going to be enforceable. And if it's not going to be enforceable, then there's very little point for us drafting that will for them in the first place. So please do make sure that we do not create conditions that are going to be unenforceable or create unnecessary complications after one's death. So an executor is the person who is ultimately going to be the person who takes care of winding up the deceased estate. Now, winding up is the process where all of the assets in the estate are realized and they're taken into account. All of the liabilities of the deceased are paid, and then the remaining assets are divided amongst the heirs, either in terms of the will or in terms of the law of intestate succession. Now, the master or the magistrate's court, depending on what the value of the estate is, will authorize the executor in order to act. Now, in a will, you can say, I nominate my sister to be my executor, for example. That is a valid nomination. If it is that there is no nomination in a will, or if there is no will at all, legislation tells us who it is that is able to act as executor. Now, in terms of the legislation, you can either be a spouse of the deceased or a child of the deceased in the first and second degree. Now, what that means is that your husband or wife is able to act as your executor, your children are able to act as your executor, or even your grandchildren are able to act as your executor. In the event that nobody else is available, then the master will appoint a professional to act. And that professional has to be an accountant or an attorney. And if it is that a professional person is appointed, then they will have to put up security, and security is an insurance policy to ensure that there is the correct process followed and there is no misadministration by the executor. And it's an insurance policy to ensure that the winding up process is in fact done correctly. And I think this really speaks to the weight and significance of this appointment. It's not one to be taken lightly. I think, and at least the discussion that I have with my clients when I draft wills for them, is that appointing somebody as an executor is not an honor. It's a position of great responsibility. It is a position which is very often difficult for that person if they need to make decisions and the family is not comfortable, or there are uneasy relationships between people. And this is why I believe that it is important to really consider how we draft a will, what the family dynamics are, what are specific and unique to that particular family that needs to be taken into consideration when an executor is appointed, when there are benefits that are going to be afforded to a family member. We need to understand what the dynamics are in that family in order to create a will that is bespoke and it facilitates the family's ongoing relationships after that person has died, because that person is very often the glue that holds everybody together. The executor must be somebody who is trustworthy and who is going to be able to make decisions, appoint somebody to assist them, who we call an agent, who is an attorney or an accountant, and to ensure that the estate is wound up according to the legislation, which is either the Administration of Estates Act or the Intestate Succession Act. And in a will, you can nominate anybody who you want to. You could nominate a family member, a friend, you can nominate a professional, but we must bear in mind that the executor is entitled to charge 3.5% of the gross value of the estate as their fee. And what this means is that there is potentially a lot of money that can be earned by the executor. And depending on the complexity or the simplicity of the estate, sometimes it is very enticing for somebody to be appointed as executor because, or an organization at least, to be appointed as executor because of the fee that they might earn. And this is very often why we see that banks will draft a will for free for their clients and hold it for them, but nominate themselves as executor, because what they don't earn in their fee when they draft the will, they will ultimately earn when that estate is wound up, when they're entitled to charge 3.5% of the value of the estate. And it can potentially be a lot of money if you calculate what is in your estate and you times that, or at least you calculate what 3.5% of the value of that estate would be. Now, a question I often get asked is, can you appoint somebody who lives in a foreign country to act as executor? And the answer to that is no. The person who is appointed as executor must be under the master's control. And what that means is that they have to live within South Africa. Although they don't need to be permanently present in the Republic throughout the winding up process. And I will say that the winding up process in our experience takes at least a year. So for all of the tasks that need to be done in the winding up process, you can budget for at least a year. So that person does not need to be permanently in the Republic, but they do need to be permanently resident in the Republic. So somebody can travel, they can spend time overseas, for example, but they must consider South Africa home in order to be validly appointed as executor. Now, if there is nobody who is a family member or a friend who can assume the responsibility, then a professional must be appointed. And if nobody is nominated in the will, the master will do that for us. And there are attorneys who work in the same building as the master in Johannesburg, for example, who are very often appointed to assist with the winding up process in the event that there is no executor appointed or available to be nominated. Now, children are always an absolutely critical aspect of the preparation of one's will and how it is that we deal with assets in the event of someone's death. Now, it's important to bear in mind that children can inherit tangible things. So a child can inherit a desk, for example, they can inherit a car, they can inherit a property, and they can receive it. But they cannot receive money, although they can inherit it until they turn 18 years of age. And if it is that they receive money in terms of an insurance policy, in terms of a will. If it is that they are under the age of 18, there are two ways in which we can deal with money that is due to a minor. The first way is in terms of the Guardian's Fund, which is a fund which is administered by the Master's Office. And it is a fund that holds money on behalf of minors, people who are unable to look after their own affairs, and unidentified heirs. So if there is nobody to whom an estate can be bequeathed, that money is also held in the Guardian's Fund. Now, if it is that you don't like the idea of the Guardian's Fund holding money on behalf of your child, then it's necessary to create a testamentary trust in one's will. And this is a trust that only incepts upon death in the event that you were to die, for example, before your child turned a certain age. And you can increase the age that your child would be likely to receive their money from your estate. Now, a lot of clients pick the age of 25. There is no particular magic to the number 25. If you believe that your child would be responsible at 22, for example, you could say 22. If you didn't believe that your child would be responsible until they turn 30, you could also nominate that age. But the crux of this, I think, is that if it is that you would not want the Guardian's Fund to administer funds on behalf of your minor child in the event of your death, you need to set up a testamentary trust. This testamentary trust has to be set up in a will. It's not a given that in the event that you die, that a testamentary trust will incept if you have not made provision for that in your will. It is absolutely imperative to create that as a condition in your will. What I've heard from people who are in the investment space, and I'm hesitant to say make any sort of assertions here, but what I've heard, and I stand corrected, is that the Guardian's Fund does accumulate interest, and that it's not bad interest that is earned and that accumulates on that amount of money for a child during their minority. And I think it's important to bear in mind that for many people in South Africa, a testamentary trust structure is not appropriate for them or their family. And the Guardian's Fund can very often be exactly what is necessary in order to protect and ensure that money is well administered on behalf of a child. And I think it's important to bear in mind that if it is that you are the guardian of a child, where there are funds in the Guardian's Fund, that it is possible to approach the Guardian's Fund on an annual basis and claim a contribution to maintenance for that child. And if it is that you or your client needs assistance with preparing a schedule in order to claim funds from the Guardian's Fund in respect of a minor child, social workers with the Department of Social Development are well placed to assist your clients with this. Now, again, this question is very often asked: what age can my child receive their inheritance? And this really depends on the particular child. And I will say, when I was lecturing, I had a student who was in one of my classes who, at the age of 18, was able to pay for his entire first year of varsity tuition from funds that they had received from the Guardian's Fund. It can make a massive difference in a young person's life in order to receive an amount of money like that. And it just so happened that he was responsible enough to know where that money should be well spent. Other 18-year-olds may not be as financially savvy or responsible. And so it's important to consider and to ask your client what sort of responsibility any particular child has. I had a consultation with a client who disclosed to me that their adult child was an alcoholic, and they were very concerned about the provisions that had been drafted in a will for them that catered for that child receiving their full inheritance in cash, and that child was already over the age of 18 years of age. And there was a huge concern that the testator had, or my client had at least, that when that money was received by that child, that they would misspend the money on alcohol and there would be nothing left at the end of the day. And so in the event that even an adult child would not be responsible enough to deal with their own money, it's possible to create a testamentary trust, for example, to cater for that particular child's challenges. And so it's very important to consult with the client to understand what the family dynamics are, what needs to be catered for that particular child and for that particular family. Now, if it is that your child is due to inherit a house, an immovable property, a sectional title unit, a commercial property, and you are to say, I bequeath my house to my child, and that house is then registered in the name of that child, and for example, that house is rented out and the rental income is used for that child's maintenance. In principle, I think this seems fine. However, if it is that for whatever reason that house needs to be sold, maybe there needs to be a lump sum made available for something that that child needs. Maybe it's school fees, for example. Maybe the rental income isn't sufficient. Maybe it isn't possible to rent out that property, and so it becomes a liability. If it is that that property is to be sold out of the minor's name, it is important to bear in mind that one cannot conclude an agreement of sale in respect of a property owned by a minor without the permission of the High Court. And what we know about seeking permission from the High Court is that it is not without an expense. It means that an attorney needs to draft papers, an advocate needs to move the application in court, and we need to have very, very good reasons why that property should be sold or alienated in order for there to be funds made available that will benefit that child. And so it can create unnecessary hindrances for the child's guardian, in the event that they receive a property that is then registered into their name, if it is that there is going to be money needed in order to benefit that child. So please, 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 whatever you do, be careful with how you draft wills, how you draft conditions in wills, and how you cater for your particular family's needs as well. Now, another question that I was asked was whether in the case of divorce, a child's inheritance should rather be set up in a trust. Now, this takes a step further with regards to the discussion about whether funds should or shouldn't be held in the guardian's fund or in a trust. And I've seen wills where there is a provision made to say, I bequeath my estate to my child, but that child's inheritance should be held by my friend Cindy, for example. And that is not a good way to set up a structure. In fact, it should not be set up like that at all. Either those funds must be held by the guardian's fund, or it should be set up in a testamentary trust. Now, when divorce happens, it's important to bear in mind that from the date that that divorce decree is granted, 3 months can pass. And if it is that one of those former spouses are to die and they haven't yet changed their will, there is a fiction that is created in law, an imagination that is created that says that if it is that the will of the person who has died benefits their ex-spouse, that we pretend in law that that former spouse predeceased the deceased. But this is just a fiction. And if it is that the time period lapses, the law assumes that it is in fact the intention of that person who got divorced to benefit their former spouse. And so it's really important to bear in mind that if it is that you are divorced or one of your clients is divorced or imminently going to be divorced, but they change their will if they do not intend to benefit their former spouse. And I think what I see, at least in divorce, is that divorce happens and then life carries on. And very often the last thing that clients think about is, in fact, their wills or benefiting somebody else other than the person that is nominated in their will. And so it's important to have that discussion with your clients, with your friends, with your family, if it is that there is a divorce on the cards or has just happened, to ensure that there is, in fact, a change made if there is a will that is already in existence. Now, if it is that, and I think this question particularly deals with, can I trust my ex-spouse to ensure that the money that I would like to benefit my child is in fact correctly spent and it is correctly administered? If it is that this is the case and there is a breakdown in trust and there is no certainty in the mind of one's client or in your mind that your former spouse would correctly allocate money to your child and rather than themselves, it's important to set up a trust or rely on the guardian's fund. And if it is that you set up a trust, make sure that the people who are tasked with administering the trust on behalf of the minor child do so in a way that is both trustworthy and in a way that's going to benefit that child. It's a very, very responsible position, and it cannot be taken lightly. Oops, sorry, I seem to have a technical problem. Another question that I so commonly get asked is about this concept of a common law spouse. Now, there are certain jurisdictions in the world where there is recognition for the so-called common law marriage. In South Africa, the general rule is that if it is that you are in a relationship with somebody, but you have chosen not to get married, whether you live together or whether you live separately to one another, the general rule is that the term common law spouse is one that is not legally recognized in South Africa. I've even heard from friends of mine that have said, well, I've been living with him for at least a year, and so I would naturally inherit half of his estate in the event that he was to die. Now, this is not true. There is absolutely no assumption that can be made that just because people are living together, that they are naturally going to inherit from someone's estate in the event of death. The law very much still considers the decision to get married an opting in. So have you opted in to get married or not? And if it is that you don't opt in to get married, should you enjoy the benefits of marriage? Should the law come to your aid? Now, there are changes that are being made to these principles in terms of case law in South Africa. And very often we see this in RAF claims, for example, that there is a recognition that marriages that are either not recognized in South African law or in the event that people are living together and have lived together for a very long time, that there may be a duty of maintenance and support that is due by the person who has died to the person who lives and remains behind. But what I want you to take from this is that to make that assumption or to rely on an assumption that there might be something coming either to you or to your partner or to your client's partners is too big a risk. And if it is that you want to benefit your partner or if your clients want to benefit their partner, the safest way to do that is to ensure that a will has been drafted. And I think what we see more and more as we pass and time passes is that people have ambivalence about marriage. Some people don't want to get married for various reasons. Sometimes it's a religious reason. Sometimes it's a philosophical reason. Sometimes people just don't opt into the institution of marriage. And if that is the case, but you still want a partner to benefit, it's important to create a will so that there is a statement of intention that is made to the whole world in the event of one's death. Pension funds are always an interesting topic when it comes to someone dying. And it's important to bear in mind that a death benefit will arise in the event that somebody dies before they reach a pensionable age. This depends on the policy and how that policy is worded. Very often you will see on your pension fund policy documents that there is a space for the nomination of a beneficiary. Now, it's important to nominate a beneficiary if it is that you intend for somebody to benefit in that policy document. And if it is the case that that policy document is silent on the nomination of a beneficiary, in that case, then the benefits that are held in that policy will simply fall into the estate and be wound up in the normal course. Whereas if a beneficiary is nominated, it's possible that that beneficiary may receive their payment before the estate is finalized. Now, the nomination of a beneficiary alone does not guarantee that that person is in fact going to receive the funds that are nominated to them in terms of the policy wording. It is at the discretion of the trustees of that particular fund to pay out in a manner that is fair and equitable to anybody who is factually dependent on the deceased. And it is incumbent upon the fund manager to identify those dependents as well as the nominees and to appoint or to at least allocate funds to them in order to ensure an equitable distribution. And so what that means and what I've seen is that if there is a child that is born outside of a marriage that even the surviving spouse is not aware of and is not nominated in that will, if it is that that child is dependent upon that person for maintenance, they will still be entitled to inherit in terms of a policy if it is that they are nominated or in the event that they are identified as a child that is dependent upon the the deceased rather, for maintenance. Now, if it is that you are preparing a will, it's also recommended that we set up a live file. Now, a live file ensures that your family, your executor, and whoever it is that is nominated to administer the estate is set up for success. What I mean by that is that it very often takes a lot of time when an estate is wound up to identify all of the various assets. And I recently assisted with a deceased estate and we wound up the estate. It took about 24 months in order to finally wind up the deceased estate. We got permission from the master in order to pay the beneficiaries. Our L&D account had been accepted, and suddenly a new asset came to light. What that means is that the final winding up of this deceased estate has in fact now been delayed. It is possible to pay out some of the funds to the beneficiaries, but there is a risk that there is a risk that the executor takes personal responsibility for the payment of those prepayments. And so if it is that you are able to create a live file where you keep things like property deeds, rental agreements, bank account details, investment details, timeshare details, details of who you employ, details of who your family members are, a letter of wishes, safety deposit box details, anything that is particularly important to your life, and you know what the various assets are that you have that is unique to you, that is unique to your particular family, and to put together a file so that your family are in fact aware of what your estate comprises of in the event of your death. And again, as I mentioned, when my dad passed, my mom and I were fortunate in that my dad was exceptionally well organized when it came to setting up a live file. And it was so easy for us to go through the files that he had created in which all of these important documents were set out. And it simply made the winding up process that much easier. And I think the difficulties that come with losing a a loved family member, the dignity that can be afforded to the deceased in creating a file like this cannot be underestimated. And so it's really, really recommended in the event that you do want to assist and aid your family members in ensuring that it's easy for them in the event of your death to wind up your estate. It's a really, really good idea to do this. Okay, so that concludes my presentation for the day. I'm not sure whether there are any questions. I'm sure that Danny will assist with fielding any questions that you might have for me in the event that anything has come up. In the event that you don't want to share your question in the chat box, you're welcome to set up an appointment with me. These are my details. My team is ready and available to take your questions from me. Thank you so much.
Thank you, Claire. That was really tightened up at least my impression of what the will should be. And I'm sure that everybody gained quite a bit of information from that. I did want to ask a question. Can you have a joint will between a wife and a husband, or does it have to be separate?
You certainly can have a joint will, and it doesn't even have to be limited to a husband and wife. Two friends could actually set up a joint will. There are two different types of wills. You have a joint will and a mutual will. Mutual will benefits the other person that is provided for in the will, whereas a joint will in and of itself can be a single document that incorporates two different testamentary provisions for two different people. So it is entirely possible. If it is that people have a joint will and one of them dies, it's important that the other person then updates their will so that they have their own individual will. But I think it's important to, if it is that you have an inclination to a joint will, rather consult to ensure that the reasons that that joint will is created is in fact going to benefit one's family. And, I think the participants in this group are probably going to be better off telling me about exemptions in tax and estates and so on, but there are lots of benefits to people when they are married from an estates perspective and from a tax perspective. So it's important that when we set up wills, whether it be a joint will or a separate will, that it takes into consideration what those benefits are.
Just asking because with my wife, what's hers is hers, and what's mine is hers.
Very, very, very wise. Makes for a happy marriage, I'm sure.
Okay, Danny, if there's no questions, we'll have a break. It's now 10:02. Next speaker is Herb Lewis, and he'll be coming on at about 10. So perhaps we should have a 10-minute break unless there's any questions anybody wants to ask at this stage. Danny, talk to me.
There's a few questions. I'm just trying to. Mervin's asked a question. Does the process of a pension or life insurance fund have to be paid into the estate or directly to the beneficiary?
So as I understand the question, it's either paid to a nominated beneficiary or a factual dependent determined by the fund administrator, or if there is no factual dependent and there is no nomination of a beneficiary, then those funds will fall into the estate itself. I hope that answered the question.
Any other questions? I'm just getting Herbie to get in because before he starts, he should be started just after 10. So I don't know if we want to do any questions before, and then we take a little break till 10 to do the second presentation.
Yeah, so you have your the information of how to contact Claire. You're welcome to do so. She's given both her phone number and her email address. And we will be sending the recording, and we will be sending the certificates for this session in the next day or so. And we'll wait now. We'll start at 10 o'clock when Herb comes on, or as soon as he comes on. So thanks, Claire. Thanks for interesting morning. Those of you who woke up early and had your thing, you now can have a second cup of coffee or whatever number during the break, and maybe a bit of breakfast. And we'll see you at 10.
Thank you so much for having me.
Thank you.
Danny,
Good morning, Herb.
can you hear me?
Yeah, I can hear you perfectly.
Okay, so will I get to show screen?
Yes, you want to share your screen in with your presentation? I'm going to be sending out the notes shortly to everyone.
Okay. So when do you want me back? In 2 minutes?
Excuse me. Yeah, let's start in at 10 in 5 minutes.
Okay, great.
So now, if you don't hear the chicken beef, I'm going to see if I have what I've done here. Then we must send that people the latest tomorrow.
Morning, Herb, in duplicate. Welcome, everybody. We'll be starting in a few minutes. See Herb Lewis has joined us. Just waiting to get things set up, and then we'll be starting. So finish that last cup of coffee and get yourselves ready. As you can see, I'm having my 5th cup this morning.
He's got her twice after one. That light.
Stan?
You take
Morning, Herb. How are you doing?
Fine, thanks. How are you, Stan?
Wonderful, thanks.
Good.
Let me just
Yeah, just get it.
okay.
Yeah.
Do you have some more light? Yeah. No.
No.
Should we not open the
No. You want to open it slightly? Let's see.
Because that light has been. Better?
Okay.
Herb, you're on twice. I don't know why.
I'm going to change it.
It's Cheryl, my colleague.
Okay,
She'll change her username.
okay. That's fine. Just to everybody who's joined us, we'll be starting in a few minutes, just waiting on Danny and Cheryl. I see Cheryl has now joined us. And we'll start in a few minutes, just let everybody gulp down that last bit of coffee or whatever, and we're ready to start. How long do you think you'll be going? Do you need a break, or are you going to carry straight through? Huh?
Carry straight through.
Okay. So, Danny, are you with us?
I'm here. I'm just trying to quickly send out the notes. Give me a couple of seconds, and then you should have your own copy. But in the meantime, we can, I think, start, and you'll be getting your notes very shortly.
Okay, so welcome everybody to the second part of today's session. We're trying the morning session for a change, and now we have Herb Lewis, whose speciality is investments, and he's going to talk to us about the taxing question of what happens when you receive that. Do you get taxed, and how much, and why, and I presume how you can avoid it, or at least cater for it. So Herb, the floor is yours.
Good morning, and thank you for having me. Can I put myself on share screen mode? Because I do have a presentation.
Yes,
and,
yes, you should.
Okay. Okay, let's do that. Can you see my screen?
Yes, we can.
Okay, so you can see my screen.
Herb,
Yeah.
can you enlarge it?
I can, yeah. How can I enlarge it here?
Zoom in.
Well, don't you have to go into presentation mode?
It's a PDF I'm showing.
Okay, so going to zoom in, you might be able to do that.
And I'm just
Next line up.
Next line up. What?
Left, yeah, you're on the right line. Just go left,
Okay, so I can't see that. Okay, show
Line in the,
video.
or you can you can right click and see if it allows you.
Just hold on 1 second.
Is that the screen one? There, where my finger is.
Yeah, but I can't see that, unfortunately. Okay, there we go. Okay, is that better?
That's perfect.
Okay, all right. Okay, so I'm going to be talking about the tax considerations when one places an investment. And
No, there's got to be a way to, sorry, just to go full screen. Let's just go view.
view.
Yeah.
If you take away, if we take away the view where we shown as part of the gallery, then it moves it, and that on my screen it's quite big.
No, but I'm saying where the way it's going, like scrolling, it doesn't look nice. It needs to, I would say, better if it goes a full screen of the slide and you go one at a time. So I'm just trying to say, is there no way that if you go view with the third option?
Okay.
Let's see. Just trying to see full screen there at the bottom. I think that might look, yeah, there, that looks better.
You prefer that?
Yes.
Okay.
Yeah,
So
that's good.
Good. Let's talk about the tax implications of investments. The general rule is that different tax regimes or rules apply to different products, and an understanding of the classification of products simplifies the tax treatment of those products. So that's the prerequisite. And we're going to go through a familiar slide that I often use in my presentations because it's a very effective and simple way of classifying products in this country. And just as an aside, as you know, or may want to know, the investment industry in this country is particularly sophisticated, particularly so. In fact, I'd argue it's not just world-class, it's often world-leading. And I'm going to try and reinforce why I think that in this presentation. So one needs to differentiate between funding for retirement and funding for the shorter term, because once we have this familiarity with the different products, we can consider the tax implications. So let's just consider the general rule, and then I'll go into a nice diagram showing how these products are classified. The government has a single incentive to get us to fund for our retirement. And that single incentive is a very attractive one. It's the tax advantage. If you had to remove that element, there would be no incentive to lock one's money up, especially in a country with so much political and economic uncertainty. And in fact, it's true everywhere in the world, irrespective of the economic and political vulnerabilities, that the tax treatment, the tax advantage, is the single enticement in doing so. And I'm going to jump ahead and say, well, if you're able to get your money out before retirement, you've kind of breached the contract with government. The government wants you to keep your money until retirement and then to purchase a post-retirement pension or annuity instead of becoming dependent on the state. But if you bail out of the contract prematurely, the government is going to force you to repay the taxes that you were granted initially. And it happens all the time when people decide to change jobs, leave the country, and that reversal is a very onerous one. So the general rule over here is that if you're funding for retirement, the advantage is the tax advantage, and we'll consider what that is. It's also so much easier to manage money in pre- and post-retirement funding products. I'll show you the diagram in a second, as I said. Why? Because we don't have to worry about tax on interest and capital gains tax. Let's get to the next general category of investment. So if you're not funding for retirement, you're funding in a discretionary fashion, and it gets its name, the general category, from the fact that one has carte blanche discretion, if you like, to put money in, take money out, put more in, take money out. But the government doesn't see itself as being advantaged because you can take your money out and do what you like with it. You're not funding for retirement and providing the government with some kind of an advantage or independence of the state. The problem with discretionary products, they would be money in the bank, they would be unit trust, they would be a share portfolio, they would be a structured product, they would be a derivative, they would be everything that's not a formal retirement funding product. So while the advantage is that you have carte blanche access to your money, dividend tax applies, 20% withholding tax. Income tax beyond one's interest exemption applies. And capital gains tax applies when one realizes the gain. And I can tell you absolutely, quite honestly, it's extremely difficult to manage discretionary money because of these tax deterrents. There is complete reliance on the performance of the stock market. And I'm going to emphasize why it is so difficult, number one, to manage money, and two, the key component of all of this, and that's the ultimate investor, for them to make money if stock markets don't move. And stock markets don't always move. And tax provides as a deterrent to the meager gains that clients sometimes realize. And then on top of that, we add the necessary element of fees. It's very difficult to make money market beating returns when stock markets don't perform. So let's consider what the various products are and what the tax implications are. I just want to confirm that I'm coming across quite clearly. Can you confirm that?
I can hear you clearly.
Okay. Okay, so let's go to a classification of investment products. So if we have a look at the top area there, if we have a look at this, let's call this a chronology, a timeline of our, if you like, a chronology of investment timeline. So we start in the bottom left-hand corner from the time that we start earning money. And let's call this darker area the accumulation phase, that as we work and earn a monthly salary or an income or a commission or whatever our source of earnings are, we save part of that. We're building up our investment base during our working years. This vertical line here is retirement. So if this is the accumulation phase where we're saving money and building up an investment base, beyond this vertical line over here is retirement, or the drawdown phase, if you like. And obviously the objective over here is to build up as big a pot of money as possible to provide us with as larger monthly income to simulate a salary in our post-retirement years. So accumulation phase, and let's call this drawdown or post-retirement phase. The classification is key to understanding the tax treatment of investments. In the accumulation phase here, we need to further differentiate between saving for retirement and saving for the shorter term. So there's this distinction between longer term and shorter term. Now, the range of products in this country and elsewhere accommodates every investment requirement. Every need is more than satisfied, and we don't need that many products. So let's look at the investing for the longer term, if you like, investing for retirement. There are only 4 products in the marketplace, and that's all that's required. So we have the company pension and provident fund. And if a company offers such a fund, membership is compulsory, thank goodness. We have a retirement annuity that's really intended for those that are self-employed or whose companies do not provide a group pension or provident fund. And then on exiting a pension or provident fund, changing jobs, one wishes to preserve the final benefit value, and we transfer that benefit value into a preservation fund. And the general rule in this country is that if you do not withdraw your money, if it's transferred to a successor product, if you like, then it isn't taxed. That's the government's incentive to preserve our money until retirement, at which time we'll purchase a pension or a post-retirement annuity. So what really are the incentives? Knowingly and unknowingly, we all enjoy the benefits of a pension or provident fund or a retirement annuity when funding for retirement. And the advantage is the tax deduction on the contribution. That's the first advantage, if you like, that there's a tax deduction. Now, I'm not quite sure to what degree you want me to cover the explanation of the tax deduction, but let's just simplify the deduction as follows. If one contributes 100 Rand to a retirement funding product and one's marginal tax rate is 35%, then one is getting a deduction in tax of one's marginal tax rate of 35% times the contribution, which is 100 Rand. So I'm getting a 35 Rand reduction, discount, if you like, on what I contribute. And that's true to what I contribute to a pension fund, provident fund, or retirement annuity. Now, that's a large concession, if you like, 35%. In fact, if my top rate of tax was 40%, I'd be getting a 40% discount on my contribution. And if my marginal tax rate was 45%, I'd be getting a 45% reduction on my contribution. I'm getting a discount of almost half of what I contribute, which is enormous. In fact, there's a bit of a contradiction there, because the higher my marginal rate of tax, the greater the discount. That is correct, right? Because a 45% marginal rate taxpayer is getting a greater discount than a 18% marginal rate taxpayer. But nonetheless, the confusion with those not in the industry, and we all are, is that the deduction is not actually enjoyed on your contribution. All that happens is that you put in your full 100 Rand, or for every 100 Rand, and then the tax concession comes separately when you actually pay your pay-as-you-earn tax. So because they're two distinct things, it's difficult for people to kind of reconcile how the two are related. So in goes your 100 Rand, but when you land up paying tax, you still get your discount of your marginal rate of tax, your 40%, times your 100 Rand. They're separate events, but they are linked, and you still get that deduction. Okay, and the same is true for retirement annuity. There are caps on this as to in terms of how much you can contribute. We'll get onto the detail later. I just want to give you an overview of the retirement funding product. A preservation fund does not take in new money, so it must originate from a prior pension or provident fund. And in fact, when we retire, we can have multiple preservation funds from multiple prior employee pension or provident funds. Sorry, employer pension or provident funds. We can have a whole pile of them. We can have a couple of retirement annuities. And in fact, we can even have the final pension and provident fund benefit from the company from which we finally retire, our last employer, if you like. The other advantage over and above sorry, I just want to go back there. The other advantage above the tax deduction, sorry, I'm just hitting the wrong button here. The other advantage over there, the tax deduction, comes to the ease with which money can be managed in a pension or provident fund, retirement annuity, or preservation fund. And that is because these products are exempt of tax on interest and capital gains tax. And that makes life so much easier. So I'll jump the gun slightly, but let's consider this. If we consider that prevailing interest rates, I've just taken best 12-month fixed deposit rates, and let's assume we could buy into one of these within our retirement funding product. Now, it's very attractive when these kind of yields don't attract any tax. The moment these kind of yields attract tax at your marginal rate of tax, it starts to become very unattractive, because then you're only getting, I don't know, 55, 60, 70% of the yield, because the tax man takes the rest. So it reinforces the general theme. Tax is a major deterrent to managing investments and a major deterrent to post-tax performance. It's not easy to make money unless the stock market performs. And we're going to have a look at some graphs a little bit later as to whether the stock market, in fact, does perform, and how, when it does, how inconsistently it performs. Okay, so let's go back to this classification. We're dealing with our retirement funding products here. And we've said that two of the tax advantages are the tax deduction on the contribution. It's a major enticement. The second is that interest is exempt. So we can plonk the full portfolio if market conditions were not suitable or desirable. We can plonk the entire portfolio in high-yielding fixed interest funds, money market funds, bond funds, a combination, and there's no tax deterrent to doing so. And also, these pre-retirement funding products, these 4 pre-retirement funding products, are exempt of capital gains tax. Now, that's a major advantage as well, because when markets look frothy, or when dark clouds appear in the global economic financial system, one can simply switch out of one's share market exposure with no tax implication. There's no deterrent to doing so. So let's jump ahead slightly and I'll come back again where we were. Let's have a look over here. This is the JSE over the past 5 years. It's a terrible ECG, as you can see. And if we look at this, these ellipses over here, the ellipse over here and the circle over here, highlighting times of dramatic sell-offs on the market. You know, at the time of the onset of the coronavirus pandemic, it was quite a simple thing to exit the market in a pre-retirement funding product. They're generally, because of zero tax implication in a pre-retirement funding product, but not so simple to do so in your share portfolio or a non-retirement funding product. So while you want to safeguard your money rather than withdraw it, there was no tax-free avenue, channel to allow you to do so. Either you paid the tax to temporarily safeguard your money, and the market landed up recovering very quickly in early 2020, as you'll remember, or because of the anxiety, and it's a very understandable anxiety, you decide to switch out of equities, pay the capital gains tax, protect your money, and possibly not go back into the market, and the market lands up where it was previously. So you can see the deterrent to both the advisor and to the ultimate investor as to how difficult it is to manage money, even if the intention is not to withdraw it, it's simply to find a parking spot, some avenue of safety during dramatic market downturns. And we saw it again. The beginning of this year, markets were at a high. American markets were at a high. And we've seen this dramatic sell-off, and it has been extreme. And it's very difficult to protect a client's money outside of a pre-retirement funding product, and a very simple thing to protect it inside a pre-retirement funding product. We'll come back to this. Okay, so 3 tax advantages, as we've mentioned. Tax deduction on the contribution, interest exempt, capital gains exempt. Let's contrast that to funding for the shorter term. So we see this horizontal line over here, and that differentiates between funding for the longer term and funding for the shorter term. And of course, the vertical line differentiates between accumulating money and drawing money down in our post-retirement years. Okay, so let's look at investing for the shorter term, or investing in such a way that you have immediate access to your money. And this would include your default position of money in the bank, unit trusts, shares on the stock exchange if you want to do your own investment management, and different, more sophisticated products that derive their value from shares, bonds, cash. We'll get onto the various asset classes or investment classes in a sec. But anything that's not a pre-retirement funding product is a discretionary investment. Again, you've got this carte blanche access or discretion to your money. Now, that's the advantage. What's the disadvantage? It's the tax implication in managing these portfolios. It's a difficult thing to do. So, typical story. You make money on your share portfolio, the market's looking frothy, or in your unit trust portfolio, the market's looking frothy or uncertain, and you want to realize, if not withdraw the money, you certainly want to reduce your risk, your share market exposure. And there's a huge capital gains tax implication. In fact, it's your capital gains tax, while it's a concessionary tax, it's still 40% of what your marginal rate of income tax would be. And in rand terms, it could be quite significant. The gist of it is that there's a major deterrent to managing portfolios actively. So what do? You keep clients in their portfolios, because for many clients, the idea of paying tax on the portfolio is an onerous one. And where's the money going to come from to pay that tax for an investment that's been in place for years, sometimes for decades? The money's probably going to come out of the investment itself. It's a huge problem in actively managing portfolios. So let's consider the alternative. So the alternative would be that you're in a market that's plunging. You don't want to get out because of the tax deterrent, the capital gains tax deterrent, but you do want to get out to protect your capital. So at the end of the day, one has to do a calculation. One has to predict, surmise as to what the extent of the market fall is going to be. And then once it's fallen, when it's going to recover, to determine whether the maths works out. So let's consider the kind of calculations that are required. So if there's going to be capital gains tax of 100 Rand on 1,000 Rand investment, that's 10% of the investment is going to be lost on tax. The 100 Rand in actual capital gains tax paid relative to what the investment value is. To justify such a temporary switch, if you like, one has to make a prediction, an assumption that the gain in doing so will be more than 10%, that one will either get in at the bottom of the market, or when one goes back into the market, one won't go back into the same unit trust fund or the same portfolio of shares. One will more than justify by performance over time of more than 10% in doing so. And I hope I've explained myself clearly, but that's not an easy call to say I'm getting out of Richmond into Anglo-American because I believe that the upside there will be more than 10% on my current holding in Richmond, but I'm going to pay the tax in any case. If we come back to, rather than shares, let's look at fixed interest over here. So money in the bank, or money market funds, or high yielding fixed interest funds. The deterrent there, of course, is tax on interest, right? So that's a big problem. I'm just going to do something over here. I want you just to confirm with me that I just want to go to something. I want to get, I want to get to a document over here. Let me just try and, well, all right, you don't have to be specific about the, exactly. I want to not on that. Okay, so we're looking at the interest exemption. But if we're looking at the interest exemption, 34,500 Rand if you're 65 and younger. So if we look at the kind of money that we can invest in a fixed interest fund without any tax implication, it's it's rather small for, for large type of fixed interest investments, because we're going to take our 34,500. We're going to divide that by, let's assume we could get 7.5% in a high yielding fixed interest fund. And that's going to give us a figure of investment amount of 460,000 Rand is the amount of capital that will yield interest for someone under 65, exempt of tax. Anything above that is going to attract tax at one's marginal rate of tax. Now, that's again a major disincentive. Again, I work on the general theme that unless you're in a pre-retirement funding product, exempt of tax on interest and capital gains tax, it becomes extremely difficult to make an investment decision. So the advantage of being in the share market is that there's no interest, or there's no interest. There's only capital gains tax, and it's only realized on any withdrawal or any switch. You have some control over when that capital gains tax event is triggered. There's no control in a money market or fixed interest type investments. One has to question the entire tax regime as to, is there, and I understand these are global regimes and they borrowed from other countries, but it's particularly onerous to try and grow one's money in excess of inflation, or even just to preserve the purchasing power of one's investments with such a tax onerous regime. So you clucked here on tax on interest. You clucked here on capital gains tax, even if the intention is just to protect your money in the short term. And markets don't always perform, stock markets. So again, the general conclusion is to make money, one has to have enormous resilience to market volatility or fluctuation, and one has to be in the stock market, because otherwise it becomes very difficult to do so. Let's just consider the classification of products to the end, and then we can consider the tax treatment. So we've already seen here that the classification of products determines the tax treatment, and we've considered two categories over here. So if this is a quadrant, we've looked at pre-retirement funding over here, because this is the accumulation phase. We've looked at saving, but without a predetermined timeline, and that we've called discretionary investments, and that in fact defines or determines the tax treatment. The tax treatment here is far more lenient in a pre-retirement funding product and far more onerous in a discretionary or non-retirement funding product. Now let's go post-retirement to the right of this vertical line. So we're going to purchase a whole number of, we're going to take our 1 or 2 preservation funds or more, our retirement annuity, and our final pension or provident fund if we're still a member of a pension fund at retirement. And we're going to consider what we should do with that. And there's a tax table that defines the tax treatment of that. There are 2 tax tables. Some it's quite confusing. For those in the industry, you do it every day. The distinction between the 2 is very clear. But let's go to this tax table over here. This tax table is the tax table that applies at the time that we retire. And the first 500,000 Rand collectively, not just of your final pension or provident fund and just of your RA, collectively, the first 500,000 Rand is tax-free. And that generally one should always exercise, always. It's tax-free money that will then get withdrawn and reinvested in a discretionary fashion. Okay, you're happy with the lingo? And then we have a tax table that looks like this. If we had to withdraw more than 500,000, and that's the tax table that applies. Okay. Let's go back. So that's the tax table that applies over here. We're going to withdraw only 500,000, and we're going to move that money into a unit trust fund investment over here, from which we will also draw an income to supplement our post-retirement income from our formal retirement funding products. So again, the general rule, as you've just seen from the table, is if you don't withdraw money, if money is transferred from one product to a destination product to a destination product, there's no tax implication. That's the government's incentive to keep preserving your money, the deterrent to withdrawing it. So everything in excess of 500,000 can purchase one of two post-retirement pensions annuities. I just want to get onto a definition that two definitions that I have to differentiate between. So this word annuity over here is used in both a pre-retirement context and a post-retirement context. So the Oxford English Dictionary definition of an annuity is an income stream. It's a regular stream of money. In the case of a retirement annuity, it's an income stream out of your pocket into the investment. And in the case of a living annuity or guaranteed annuity, it's an income stream back into your pocket from the investment itself via monthly or scheduled withdrawals from the investment itself. So they are both flows of money, but in the opposite direction, into the investment from your pocket and out of the investment into your pocket. And that distinction is important. The terminology is important because so many people get it wrong. Okay, so now we purchase our pension over here. And I'm not going to differentiate too much between these two products, but the guaranteed annuity is purchased through a life assurer. You give them your lump sum of money, and they're going to provide you with a lifelong pension or annuity. With an escalation, without an escalation, typically it's with an escalation at either a fixed rate of increase or it's linked to inflation. But the essence of it is that it is taxed as if it was salary. A living annuity, exactly the same. With a living annuity, and we can discuss the characteristics and the workings, the mechanics of these products later. I just want to deal with the entire classification of these products first. So a living annuity, you withdraw your 500,000 Rand and the rest you put into a living annuity, and now you're going to draw down your own capital. And the benefit of this product, if you get it right, is that you control the income that you withdraw within limits. And ideally, the investment, because the money is just transferred into a new product, into an assortment of unit trust funds. So you are possibly in the same unit trust funds that you were pre-retirement, but you're now drawing a monthly income. And that the rate of growth is in excess of the rate of income or the rate of depletion. So at the end of your lifetime or at the end of a predefined period, you have more money than you started with, even after having drawn an income. And on your death, that money passes to your beneficiaries. The problem is that you can't predict with certainty. There's no guarantee on the underlying performance of the investment. And if the investment is managed poorly, or you draw an excessive income, the massive drawdown rate is typically about 6% of your capital. You want it to grow at 9 to 10%. That's the ideal model. But if it's invested recklessly and it grows at 2% and you're drawing it down at 8%, suddenly the model falls apart. There is no guarantee in the income, whereas the guarantee is provided in a guaranteed annuity, except on the death of the annuitant, the pensioner, the recipient, no capital passes to the beneficiaries. Okay, so that's just a short explanation of the mechanics of the products. What we're interested in is how is this income taxed? And it's taxed as if it was salary. There's only one pay-as-you-earn tax table, as you know. There's no preferential treatment, if you like, via a separate tax table for pensioners. No. So again, taxed as if it was salary or any other source of taxable income. Okay. There's one other category in this quadrant, this fourth quadrant over here. And that is that at the time of retirement, you would want to start with depleting or drawing an income from your discretionary investments. You've got a nice share portfolio, you've got a nice unit trust fund portfolio, you even have money in the bank. And you now want to supplement the income here from the income here. In fact, for certain people, sorry, I need to switch this off. For certain people, most of their money may be here. For entrepreneurs, for those that have sell businesses that didn't, if you like, save primarily via the formal retirement funding channel of these products, they may have a larger proportion of their capital here than here. Just as an interesting observation, my observation, personal experience, those that accumulate most at retirement are not necessarily the highest earners. They are those that have worked uninterruptedly from their early or mid-20s to their mid-60s. They've made that compulsory contribution to a pension or provident fund, and even when changing jobs, they immediately make that compulsory contribution to the successor pension or provident fund and have done so uninterruptedly. In my experience, those are the people, that's the profile of investor that has accumulated most, generally, at retirement. Of course, there are those that sell business in the entrepreneurial types, where they are able to sell a business. But generally, they're certainly not as diligent, if you like, in paying themselves first into a retirement annuity for the self-employed entrepreneur or the smaller company without a pension or provident fund. So one cannot understate or overstate, if you like, the benefit of a compulsory contribution to a pension fund or provident fund as an employee. One cannot overstate what a positive effect that has on the individual's well-being and on society's well-being because of that compulsory contribution. But let's get back to the entrepreneur over here, or those that retired with a large retirement-linked gratuity, which is at the discretion of the company. And in this case, they are paid, if you like, a bonus on a post-tax basis, and that bonus is reinvested, or it's a combination of a gratuity at retirement on top of, over and above, discretionary savings during their working years. We're looking at the accumulation phase over here. Now, there's a very attractive tax avenue over here, because if you schedule a monthly income from your unit trust portfolio or your money market fund, it's not income as defined. You're making monthly withdrawals of capital to simulate an income, or to simulate a pension, if you like. So the idea would be to draw some of your money here to a point and to supplement that with tax-free withdrawals from your discretionary component so that you don't put yourself into higher and higher marginal rates of tax. There's another, so this distinction between drawing a post-retirement income from a formal pension and from discretionary sources is an important one. So we've discussed one huge advantage, and that advantage is in the tax saving on income. Split it between here and split it between here. That's a grand idea. The other advantage over here is that this money, this kind of discretionary money is not limited to the country, if you like. So for those that want to leave the country and to emigrate, or to do other things, to invest this money is accessible. You can do things with it. Whereas the most you can do with an annuity, well, there's not much you can do with a guaranteed annuity. The amount that you receive with a predefined escalation is fixed for life. There's some adjustment in a living annuity between 2.5% and 17.5% of the capital, but you can't do more than that. You can't take that money out as a lump sum. Whereas the discretion does exist to do so with discretionary money. You can withdraw your money. It gives you a huge advantage over the already discussed tax advantage of monthly draws of capital rather than income. There's another advantage, by the way, just in terms of tax optimization or tax saving, and that you can transfer part of your investment value to a spouse. There's no donations tax implication, and by splitting the investment, the interest and the capital gains tax implication is now shared between two spouses. And more than that, it offers both spouses protection. If the one had to predecease the other, at least they have whatever they own in terms of immediate assets, and the rest they would inherit in time. But that takes a while before an estate is wound up. So it's a very tax efficient and protective mechanism to split investments between spouses. Okay. Danny, are we doing okay?
Yeah, we seem to be fine.
Okay. So we make this distinction between the retirement funding, non-retirement funding or discretionary funding, and our options at retirement. Now let's go into the tax implications of that in greater detail. So we also said exempt of income tax, exempt of capital gains tax, tax deduction on contribution, no tax concession here. We'll just consider that in 1 second. There's a couple of exceptions here. Here you're paying income tax as if it was salary. Here you're drawing an income. You're drawing an income, but what you're really doing is you're simulating a pension by making monthly withdrawals of capital that do not attract income tax. Okay, so we've all heard of the endowment product, and the endowment product over here, it's typically for a 5-year term. There are some exceptions, but the endowment product, you put your money into an endowment, you choose a selection of unit trust funds, and it gives you the tax advantage of paying 30% income tax fixed and 12% capital gains tax, 40% inclusion rate of that 30%, which gives you a 12% fixed capital gains tax rate. Now, for some, that's advantageous relative to your marginal rate of tax and the maximum capital gains tax rate of 18%. So the other advantage of an endowment, so it's taxed separately, right? Specific taxes apply. And it's deducted within the investment itself. But the other huge advantage, not only are you paying a lower tax, but you're splitting your taxable investments, if you like. You've got the endowment and you've got the rest of your discretionary portfolio. I'm just using the investment lingo that I'm reinforcing all the time. And by doing that, we've now got an element of tax splitting, because what's in the endowment is not something on which you're going to receive your IT3C and IT3B tax certificates. So it's going to reduce the taxable component of your investments. It's a very effective tax planning tool by splitting your investments between endowment and non-endowment. The other advantage of an endowment, and I gave a presentation for Danny a few months ago, and the theme of the presentation is how to circumvent one's estate with one's investments. Because as you know, not only, well, estate duty is a difficult one, if not impossible one to dodge. There are ways and means by which you could do so legally and cleverly. But the real problem is that given the inefficiency of the government bureaucracy, it's just taking so long to get money from estate to beneficiaries. And one has to ask, are there effective ways by which one can circumvent the estate, even if one has to pay capital estate duty on that? And so let's consider that for a second. So one of the advantages of an endowment product is that you can name a beneficiary. You cannot name a beneficiary in the case of the other discretionary products. You can also name, and in fact, you're required to name beneficiaries in a pre-retirement funding product and in a living annuity investment. And what's the benefit of that? So now we've moved beyond income tax on interest, capital gains tax. Now let's look at estate duty. So, and I'll summarize this, you'll see in a nice table. That's the product, and these are the various taxes that do or do not apply to each of these products that you're becoming familiar with. So when there's a beneficiary, money goes straight to beneficiary, and it circumvents the estate. That's a crucially important thing, because beneficiaries often need their money. The surviving spouse needs his or her money immediately. He or she has next month's bills to pay. So in a pension or provident fund, on the death of the member of the fund, the money is paid on a lump sum basis. I'll tell you the tax implication now, but the money is paid immediately to a beneficiary outside of the estate. Now, what are the tax implications? We'll discuss the tax implications in a second, but what's important is on a post-tax basis, money reaches the beneficiaries immediately. And that's also the case for a retirement annuity. The money is necessarily paid out as a lump sum. You do not take over a pension or provident fund from the deceased member. You do not take over a retirement annuity from a deceased member. You don't do that. You do not take over a preservation fund from a deceased member. So pre-retirement, the positive is that the money does not fall within the ambit of the estate. It gets to the intended beneficiaries immediately, or certainly as soon as possible, as administratively possible. It's okay. So that's the advantage here of these pre-retirement funding products. Whereas in the case of all these discretionary products, but for the endowment where you may name a beneficiary and they will get the money immediately, this money now goes into one's estate. And that is a major hiccup. So another tax advantage of a pre-retirement funding product, and a huge advantage in the case of the beneficiaries of an endowment. And endowments are being used more and more and more often. I mean, I've just emphasized the tax advantage, a fixed rate of tax, and the provision, the ability to designate a beneficiary who will receive the money immediately. Offshore endowments also exist, administered by local administrators, have become very popular. So your money is invested in an overseas endowment with a specified beneficiary, a nominated beneficiary, and they will then get the money that can then be left overseas. That money need not be brought back. Okay. In the case of a post-retirement living annuity, if the annuitant dies post-retirement, they've already purchased the living annuity investment. On their death, the investment can be fully withdrawn, as it necessarily must be pre-retirement. We'll go over that in a second. But the government's tax incentive is that the beneficiary, typically the spouse, and on the death of the second spouse, typically the children, that they inherit a living annuity in their own name. They get the lump sum of money, and then they decide on what kind of income they want to draw. But the transfer from deceased to beneficiary is on a tax-free basis if the beneficiary decides to continue with the living annuity. And that's why youngish people in their 30s and 40s own living annuities. They inherited them, and they decided to exercise the huge incentive of having the investment transferred as a living annuity in their own names. The downside to that is that as long as you're alive in a living annuity, it's extremely difficult, if not impossible, to deplete this thing, because the most you can take in terms of an annual income is 17.5% of your capital. It's going to grow at 9 or 10% if managed optimally and responsibly. And there's no disincentive to go into fixed interest because there's no tax on interest or capital gains tax in a living annuity. You're only taxed on the income that you draw. Yeah. So you never can deplete this baby. And there's no way for you to fully withdraw this money except on your own death. And we'll discuss that in a second. Whereas money over here passes into one's estate, and that is potentially subject to estate duty after one's 3.5 million exemption. One may have inherited a 3.5 unused exemption from one's spouse. And so on the second to die, or following the second to die spouse, the children may enjoy, or the beneficiaries may enjoy, a 7 billion rand estate duty exemption. So let's consider what happens if one withdraws one's money or dies in a pre-retirement product. Danny, can we have 1 second break?
If you want to have a break now, you can, and then start again.
I just want to move. How's everyone doing there? Are we doing okay?
I think everyone's okay.
Okay, so let's continue. Okay, so we spoke earlier about withdrawing money at retirement, and we decided that if you like, the most tax efficient thing to do is to only withdraw 500,000. And we also said that there are 2 tables that are incredibly confusing initially. And we're going to use this tax table over here called the retirement fund lump sum table. And this is the baby over here. Let's now consider what happens if we die pre-retirement. We die over here before we've retired. In this case, the beneficiary or beneficiaries must fully withdraw the money. There's no other option. And we go down. Sorry, I just want to make this distinction again. So if we pre-retirement and we die, the product cannot be transferred to the beneficiary if it's a pre-retirement funding product. If it's a post-retirement funding living annuity, then yes, the beneficiary can inherit the self-same investment. It's transferred into their own name, but they can inherit the investment without any tax implication and draw an income in their own right. And that happens all the time. But let's consider what happens in this quadrant over here, where one of 2 things are going to happen pre-retirement, right? Either the member is going to resign or get retrenched or die. And there's a tax implication on that. So we go back to these tables. If a member dies or resigns pre-retirement, the self-same tax table applies as if they had lived all the way to their date of retirement. So the beneficiary or beneficiaries, in this case, would only, so the member of the pension fund dies, they've got R1 million as a current pension fund benefit. And the beneficiary is forced to withdraw the money. No other choice. The first 500,000 Rand is exempt of tax. It's R1 million, right? The next 200,000 Rand is going to be taxed at 18%. And the next 250,000 Rand over here, we have R1 million over here, right? So we get the next 300,000 over here. The next 300 will be taxed at 27%. And that's what the beneficiary essentially will inherit on a post-tax basis, as per this tax table over here. Okay. If the investor has more than one pre-retirement funding products, they have a few preservation funds, they have 1 or 2 RAs, and they were a member of a pension or provident fund, well, it's cumulative. So now beyond $1 million, the first 50,000 above $1 million is also going to be subject to a 20% marginal rate of tax. And beyond that, 36%. So these tables are said to be, as you know, the lingo in the industry, cumulative. You add it all together. It's not per investment product or pre-retirement funding product. You add them all together. And that's why when they start drawing from, so they paid the benefit from the pension fund or the provident fund by the employee benefits administrator. And then they also have a benefit from a retirement annuity, and it's taxed much more onerously than was the first pension or provident fund. And this is the reason, because it's cumulative. Okay, so that's what happens at F. Let's consider the far more likely scenario, and that is resignation or retrenchment. So we're looking at this quadrant. Again, the tax treatment is determined by the classification of product. pre-retirement, discretionary, post-retirement pension, post-retirement discretionary. That defines the tax treatment. So now they decide to resign. Pension, provident. Let's have a look at RA. Let's have a look at preservation fund. Unfortunately, one of the most common queries that investment advisors are getting is, can I take all of my money out of my retirement funding products? I'm emigrating. And the answer is, on resignation, you can take your full pension and provident fund benefit, if you're a member of such, subject to a tax implication. We're going to look at that familiar tax implication now. You can exercise one preservation fund withdrawal without any questions asked, subject to a tax implication. If you make a preservation fund withdrawal of lesser than the full amount and you leave some money in that preservation fund, it means that on immigration, you want to get the rest of the money, if you like, because you didn't exercise, while you exercised one withdrawal that you were allowed, no questions asked, you didn't take all the money. So what happens to the money left in a preservation fund after the one withdrawal? And a retirement annuity does not allow you to make a withdrawal pre-retirement unless you formally immigrate, or you become permanently disabled, and that's unlikely. So let's consider the familiar question of what happens on immigration. So you can take your full pension and provident fund, and let's assume that you have one or more preservation funds from which you haven't exercised your one withdrawal. What's the tax treatment on doing so? So unlike death, where you're paying somebody, or where somebody else accrues the benefit or enjoys the benefit, on resignation, the money is going to be withdrawn by yourself. The benefit accrues to you. And the tax treatment is a different tax table now. So on death, it was this tax table, the less onerous tax table, the first 500,000 Rand tax-free. But on resignation, there's another tax table, and we call that the pre-retirement fund tax table, if you like, versus the at-retirement fund, at-retirement tax table. And in this case, the tax treatment is more onerous. It's almost as if it's not almost, it is. It's number one, a deterrent to withdrawing one's money. One should instead, on resignation from a pension or provident fund, one should transfer the money to a preservation fund, and there'd be no tax implication. Tax is only paid when one puts money in one's pocket. But you're immigrating. So you're subject to this tax table, and it's cumulative. First, you apply the pension fund benefit. Then you apply the first preservation fund benefit. Then you apply the second preservation fund benefit. And by the time you have fully withdrawn your money, you have paid an enormous amount of tax that starts here. It tends to the 36% marginal rate of tax. And what's the government's justification to doing so, other than to try and act as a deterrent? Remember the tax advantages that we spoke about. Pre-retirement funding product, tax deduction on the contribution, exempt of interest, exempt of capital gains tax. But what did the government want out of this? The government wanted you to fund for retirement and not be dependent on the state, to be self-sufficient in your retirement years. But the requirement was that you reached retirement. Now, the person resigning and withdrawing their money or putting it out because of immigration is kind of breaching that contract. And it's an implied contract with government. They're now saying, no, we can't grant you that tax concession anymore. In fact, we're going to reverse it. And that's the justification for a tax table like this. It reverses the enormous tax benefit offered to people to fund for their own retirement. It gets more complicated in the case of the retirement annuity and the second withdrawal from a preservation fund. So let's have a look at this visually. We've gotten the money out of our pension or provident fund on a post-tax basis. I've shown you the tax table. We haven't exercised our one withdrawal from our preservation funds. It's one withdrawal per preservation fund, and each preservation fund would originate from a separate employer provident fund. So we can get the money, but subject to a tax implication. In the case of the retirement annuity, it's not so simple. The government says you must have been out of the country, non-resident for tax purposes, for 3 years. So you can't get that money prior to leaving the country. You can only do so 3 years later. And in fact, if you have some money left in a preservation fund because you exercised the first withdrawal, there's no restriction on that, but to exercise the second withdrawal, you also have to have been out of the country for 3 years. You have to be non-resident for tax purposes for 3 years. So you are necessarily leaving some of your retirement funding money behind. It's a very onerous thing to do. And again, this is the specific tax table that is applicable. Okay, so let's go back and let's consider over here. If one dies in a living annuity, one can't withdraw one's money to emigrate once one has retired, or one can't withdraw more than the 17.5% a year that you can get paid annually. So incredibly frustrating thing for people that have saved throughout their lifetimes, wanting to join their children overseas, have purchased the living annuity, and they cannot get their hands on their money to go overseas. So the only option they can do is to draw a South African sourced pension and via arrangement with their retail bank, have the money paid across to wherever they are in the world. And that the quantum, the amount of money is obviously a function of the prevailing exchange rate at the time that they receive their money. But that's the best they can do. Their beneficiaries can only inherit from the living annuity on their death. And on the death of the living annuitant, as this tax table applies. So we're not resigning, we're dying. So this is the general rule, right? We're dying. So again, if one has, it's possible to have pre and post-retirement funding products because you've got a living annuity, but you still have a retirement annuity that you haven't quite transferred into a living annuity. So again, it's cumulative. At the time of death, your pre and post-retirement products are added to this. And that's then paid to your beneficiaries on a post-tax basis. So one can argue that it doesn't attract a state duty, and it doesn't in a pre- and post-retirement funding product. But you're only going to circumvent this. Okay, so on the death of the, I just need to go back over here. So it's nice to say no estate duty. It's nice to say that there's no estate duty over here. And that's great. But the problem is that if one looks over here, there's an onerous tax to pay if one dies in a pre-retirement funding basis and one takes the money. It's an onerous tax to pay even though it's not estate duty. And the same is true over here, where we have a living annuitant that's died. The spouse lives overseas, or the spouse wants the money. And that money, even though exempt of estate duty, because it doesn't fall within the ambit of the estate, is then subject to what is onerous tax, especially if one's already withdrawn money from this tax table, or as per this tax table. It starts to get quite onerous. Okay, let's consider a couple of other things over here. I just want to get on to resignation. Sorry, I want to get on to retrenchment, which is a small thing, but it's worth covering. So if one gets retrenched from one's pension or provident fund, from one's company, and one is essentially forced to withdraw or transfer the benefit from a pension or provident fund, what one should ordinarily do is fully transfer the benefit to a preservation fund, because again, the general rule, what you transfer to another fund is not taxed. What you put in your pocket is potentially taxed. And you need the money. you've been retrenched and you need the money, or you decide that you want to withdraw the money. There's a slight concession. So these two tax tables over here, this is resignation pre-retirement, more onerous. This is on death if the money's withdrawn, pre-retirement, or on death, post-retirement, less onerous. If you are retrenched, then and you fully withdraw your benefit, you decide not to preserve it or transfer it to a preservation fund, then the less onerous tax table applies. So you can see over here that you can withdraw the benefit subject to less onerous tax than would otherwise be the case if you resigned. I just wanted to mention that distinction over here. Okay, let's move along to tax on investments. So now we're considering, how does one make I suppose the highest yield in an investment? So we have to take into account that we're going to pay tax on interest here, subject to capital gains tax here, not so here. Yes, we're going to be subject to tax on interest here, capital gains here, and no interest and no capital gains tax here, but we're going to get taxed on income, on our pension over here. Okay. But at the end of the day, whatever the tax implication is, we're trying to maximize the return at measured risk, whatever that measured means. By risk, I suppose we mean the extent of loss. They say fluctuation, but it's really only downward fluctuation that we worry about, the potential for loss, and that can sometimes be significant. So there are only 8 asset classes, only 8 places to invest in the world. I'm talking about in a passive investment, not an art collection or a vintage car collection or in a property portfolio. I'm talking in financial markets that we outsource to somebody else within our retirement fund or discretionary investments. So the idea is to make, well, let's consider, to make as much money as possible and minimize risk in the process. There are only 8 asset classes. That would be South African cash, government bonds that generally pay higher yields than cash, shares on the stock market, and let's consider listed property to be a separate asset class. It had the characteristic, it behaves too much like a share, but it had the characteristic in the pre-COVID area and in periods of greater political confidence, where it was like a hybrid because it had a predictable earning stream, rental income, and yet it was a listed share. So it's kind of behaves like a bond in the sense that rental income is, I suppose, comparable to fixed interest from a bond. And because it's a traded share, it behaves like an equity as well. Okay, so those are the 4 local primary asset classes. And then we have 4 more, and only 4 more. And those are international, cash, bonds, equities, and listed property. So there are only 8 asset classes to choose from. And I like to use the analogy of an investment advisor being a restaurateur. Our menu offers you 8 different dishes. That's all we can offer. There are only 8 different dishes. And the idea is to choose the asset class or asset classes that are likely to perform best in the prevailing investment climate, and to switch around as the investment climate changes and each of these 8 asset classes start to become more or less appealing. Now, it's firstly, that said more simply than is done, because it's very difficult to predict the future. And not only that, but there should be a cause and effect between the prevailing economic environment and the performance of the share market. There should be, and the prevailing political climate and the performance of certain companies and sectors of the share market. The cause and effect should be far more scientific and far less random than it is in practice. And that makes the life of investment advisors and investors particularly difficult. The lack of cause and effect, of event and consequence. When that breaks down, it becomes quite a random speculative process. And that's a major shortcoming and a major frustration for everybody concerned. Okay, so we have these babies over here. The problem with cash and bonds is the potential interest component, as you say. So far more appealing for a conservative investor in a tax-exempt product like a pre-retirement product or in a living annuity type product. In fact, one can argue that if prevailing bond yields are 7 or 8% or 8.5%, why not plonk an entire living annuity into fixed interest? And because there's no tax on that. And the additional monies that they may have, you can plonk into a share portfolio because that interest would otherwise be taxed. And now you've got a nice split between tax-exempt interest and the equity component should equity markets perform. So there's the old adage. I'm going to come back to these 8 asset classes. Danny, how much more time do I have?
Well, you got another 45 minutes.
Okay. So as you can see, I love talking. So I'm going to exploit my 45 minutes to the maximum. I hope I'm not the last person standing. All right, so let's look at these 8 asset classes over here. So again, the general strategy is allocate money to those asset classes that are likely to outperform and avoid those asset classes that are likely to underperform with due consideration to the tax implications. And where tax on interest is exempt, or put the fixed interest component in. And where capital gains tax is exempt in a pre-retirement funding product or post-retirement living annuity, you can just move money around without any consideration for the tax implications as we discussed at the outset of this investment. So let's consider these 8 asset classes. By the way, I just want to go back over here. I've said there are only 8 primary asset classes. And in the menu, it's an 8-dish, an 8-item menu. But we can mix and match a little bit. But essentially, there are only 8 asset classes. So things like derivatives, options, futures, warrants, structured products, guaranteed products, all these fancy things still have their basis, the determinant of value in those 8 asset classes. Generally, if any of those 8 fundamental asset classes perform well, the derivative will do well, and in fact, the benefit may even be amplified. It's also true that if any of those asset classes do poorly, the derivative, buying something whose value is derived from the primary asset class, the derivative will have an amplified negative performance if the performance of the primary asset is negative. I mean, there are other alternatives where you can benefit from a falling stock market. So we won't go onto shorting a share and those kind of things, but let's just confine the discussion to the fact that there are 8 different asset classes and other fancy things, giving this a seemingly endless list, really have their value derived from those 8 asset classes. Okay, so let's consider how difficult things can be. So if we look at the performance of the stock market, I'm going to look at it last year and I'm going to look at historically. So that's not very good, right? 0.1%. It's a hell of a lot better than certain American markets. But the JSE gave us a 1-year return of 0.1%. But if we do the following, look at the 5-year trend, you know, it's not a very reassuring, warm and fuzzy kind of chart that you want to show either a new prospective investor, or a seasoned investor, because of the complete lack of predictability. And even though things like balanced funds give the fund managers this wide discretion to allocate across these 8 asset classes, they seldom get it very right. They kind of stick to these fixed allocations, 40% local equity, 20% offshore equity, and 40% South African bonds, or 30% South African bonds and 10% cash. And they don't hover away too much from that because of their inability to read the markets. It's far more random a process than, an accounting textbook would suggest, using all these numerous methods of valuing a company. And there's several, as you know better than I do, there are several valuation tools by which we can determine the value of a company, the most common being discounted dividend model, where we predict earnings, we predict the dividend, we discount future dividends at the prevailing risk-free rate to today, we add them all together, and that's the fair value or theoretical value of a share. Seemingly a lot of predictability in what earnings should be, what the dividend should be. So how do we get it wrong? And the answer lies in sentiment. It's a marketplace, and that makes life very difficult. Okay, so not only is the market incredibly volatile and uncertain, so if you had to draw a line, a kind of horizontalish, slightly inclining line over the past 5 years, returns are really quite dismal. And sometimes I think, and I'm being absolutely frank with you, sometimes I think an investment in the stock market is kind of analogous to playing golf. You live a lot on hope. So as you know, with golf, you go and play those first 17 holes, and the ball goes into the rough on the right, and then you shank it, and then it lands up in the rough on the left, and then you hit it into the bunker and over the green into the other bunker. And it's an absolute nightmare for 17 holes. And then you don't know what you do right on the 18th tee, but you kind of stand and you're exhausted and you can't wait for that cheese and tomato sandwich, and you hit the ball, exhausted, and it goes down 250 meters in the middle of the fairway. And you say to yourself, yes, I can win this. So much so that you come back next week. And sometimes I think that that's how we work with the share market, because there's an incredible amount of hope rather than reality that goes into this. And people will tell you, oh, well, look at the past 100 years, look at the past 50 years. Well, nobody has that kind of investment horizon. And not just that, but no one has the ability, the mindset, to leave their investments alone when they are subject to such volatility. In fact, the analogy that I use for that is when you're on a treadmill in the gym and you're getting tired, and not even when you're getting tired, it's near impossible not to look at the clock, not to see how far you've gone and how much time left. It's just not consistent with the human condition. So it's not possible to avoid looking at one's investments all the time and looking at them over the shorter period of time. So let's just take something back. Okay, so we're going back to, we discussed earlier the difficulty in realigning portfolios when there's a large capital gains tax implication. So now you're going down with the market, or you're going to pay capital gains tax, and the market's going to land up where it was, and you've already paid capital gains tax. The tax law makes it extremely difficult to manage portfolios that are not tax exempt. Let's have a look at the US NASDAQ index. And I'm using this. I can use the S&P index, the largest 500 companies, but the truth is that the money and the focus goes on the large US tech companies. That's where it is. And if you look at the 1 year return, and it's even lower year to date, we're down nearly 30% from an index made up of the world's most sophisticated and visible technology companies with tentacles throughout the globe. These are extraordinary kind of returns, negative returns, that induce an extraordinary amount of anxiety. And if one had is subject, and again, I'll come back to an interesting point over here. The old adage that it's not timing of the market, but time in the market is absolutely not true. It's all about luck, sometimes skill, buying into significant dips where the cause of the dramatic sell-off is likely to be short-lived. But timing is absolutely fundamental. So while one can't predict when markets are going to tank, what one can do as an investor, and certainly as an investment advisor, is recognize that after the fact, that the market is dramatically lower and capitalize on that opportunity. You need to be brave as a client and as an advisor to a client. But that's when opportunities need to be capitalized. The lower the market, the greater the likelihood of upside, and the lower the likelihood of further downside. One can't always get it right, but that's the truth, that by making incremental returns and managing portfolios more actively is the success to invest, is the key to investment success. And that brings me just to another point. So we said here that the deterrent to managing a portfolio like this is the capital gains tax implication in a share portfolio. This is the JSE All Share Index, right? And similarly, if you were offshore, I mean, you would have wanted to exit at this point over here, right? But you didn't because of the tax deterrent. Now, tax law allows unit trust funds to trade portfolios on a tax-exempt basis. So it's even more reason and more justification for fund managers to be actively managing portfolios where they have the discretion to do so. And as you know, there are well more unit trust funds than there are listed shares on the Johannesburg Stock Exchange. And those unit trust funds invest in the 8 asset classes that we discussed: local, cash, bonds, equities, shares, and listed property, and international, cash, bonds, equities, shares, and listed property. And the unit trust funds are classified such that they only invest in South African shares, or they only invest in South African bonds, or they're money market funds, or they only invest in listed property. And similarly, they invest in international shares only international bonds, only international listed property, only international cash, dollar cash, pound cash, whatever the case may be, or the most popular variation of unit trust fund or the balanced funds, locally or internationally, where they mix and match across these asset classes, more in shares when the market is cheap and likely to recover, less in equities where the market is poor and the prognosis is poor. And they need to get this weighting, this allocation right, and they can do so without any capital gains tax implication. It's done within the fund itself. So a pure equity fund, the Coronation Top 20 Fund, the Alan Gray Equity Fund, you name it, whatever your preferred fund is, they can trade those portfolios without any capital gains tax implication. The moment you switch from a fund into another fund in a taxable product, capital gains tax. Or in a share portfolio, your own share portfolio, capital gains tax. You're switching from, you're switching from Naspers or Richmond or whatever the case may be into money market just as a temporary preservation fund strategy. Okay, so that's an important point. Okay, so we've discussed these very attractive yields, but these yields are only attractive. By the way, the P, this tells you the minimum amount. I've given you an indication here of what the best 12-month fixed deposit rates are, just as an indication as to what you should expect from a more aggressive investment portfolio, and with due consideration to, well, will it be taxed or won't it be taxed? And that depends on the nature of the underlying product. So we look at these kind of returns over here, 12-month fixed deposit. Can we do better in equities? Can we not do better in equities? Is there tax on this, or is this on a post-tax basis because it's an exempt product? This, by the way, refers to the fact that these rates are only offered for those over 65, I think it is, or over 60, pensionable age. So there's a slightly more attractive yield. If you're a pensioner and you put in $1 million, then the nominal yield on a 1-year deposit is 8.34%, and because it's compounded monthly, you're going to effectively get 8.67%. But it depends on the tax implication. Not so simple to put your money in a money market fund, getting these returns at a 40% marginal rate of taxpayer and well beyond your interest exemption. And again, I'm reinforcing an important thing. It's not so easy to make money at the best of times, and it's much more difficult to make money on a post-tax basis. And then gooi in the fees after that. An investor, the entire investment market has extreme reliance on a strong stock market. Failing that, and that's not always the case, as we've just seen, investment performance and the appeal of the stock market is vastly overrated, exaggerated, in my opinion. Okay. Let's have a squiz here at a summary of what we're speaking about over here. So I just want to go back to, I'm going to come back, all right, we'll do it over here. Okay, so let's, as a summary, consider the classification of product and the specific taxes that may or may not apply to those products. So these guys here, up until this blank line here, these guys here are the retirement funding products, right? They are these guys here. Let's have a look over here. So they are these guys here above the horizontal line. And the important distinction is between the accumulation phase, the pre-retirement, and the post-retirement phase. And then we're going to look at a couple of discretionary investments. No tax advantage other than the 30% income tax on the endowment. No tax advantage, but you can get your money when you want. Yeah, tax advantage, but you can't get your money when you want unless you subject yourself to a very onerous tax implication to reverse all those initial tax advantages. Okay, so that's why product classification is absolutely key. So let's go along to a summary down here. Okay, so let's look at our only 4 pre-retirement funding products. There's no tax on interest, right? There's no dividend withholding tax of 20%. There's no CGT. Okay, let's consider this estate duty story. So we said, as a summary, I'm being repetitive, but I'm just reinforcing what I've said. So money passes from pre-retirement fund product to beneficiary. The beneficiaries over here cannot purchase the same products that they were intended. If they cannot, they can purchase over here, they can purchase a living annuity or a post-retirement pension, but they cannot stay in the same product. But generally, the option is to withdraw the money. And if they withdraw the money, rather than purchasing a pension in their own capacity, if they do that, it's subject to, so while no estate duty, because there's no estate duty, but they're choosing to withdraw the money. So if they do that, we look over here, we're subjecting that withdrawn money to this tax over here. If we have a look at over here, so the tax treatment on debt, as we said, we're now referring to the tax table if one chooses to fully withdraw the money where the deceased had a pre-retirement funding product. Okay. The living annuity, there's no tax on interest or capital gains tax, but you taxed on income that you draw as if it was salary. And again, what happens on the death of the living annuitant? So if the beneficiaries decide not to purchase a living annuity in their, or could be either a living or guaranteed annuity. If they decide not to purchase a pension in their own right, in other words, they decide to withdraw the money, we come back to the old tax table. It's the old tax table over here. And the problem with this is that it's cumulative. At retirement, the deceased may have withdrawn 500,000 and a little bit more. And now the beneficiary is adding to that in determining what the beneficiary is going to inherit, draw out on a post-tax basis. There's a huge incentive to transfer what one inherits from a pre or post-retirement funding product to pension. Okay, let's have a look over here. Guaranteed annuity offers no lump sum benefit. So one is taxed on income. It's a slight variation on that, in the sense that it's partly interest that one is paid. Remember, on retirement, one takes one's pension fund value, one withdraws 500,000 and one gives the rest to a life assurer, and they give you an income for life. And they're going to run down that capital. So they're going to be paying you a combination of the interest you earn and a drawdown of capital. So it's taxed more favorably than would a living annuity investment, guaranteed income. Okay. And let's have a look over here at the discretionary component over here. So your share portfolio, unit trust, your endowments, subject to income tax and dividend withholding tax, slightly preferred rate of income tax on the endowment. Subject to capital gains tax. I mean, there's a 40,000 Rand annual capital gains tax exemption, but that's all there is. And the endowment, again, subject to capital gains tax. By the way, exemptions don't apply in endowments. They don't consider your interest in capital gains tax exemptions. They just tax you at the lower rate of tax. The assumption here is that you've enjoyed your exemptions in investments outside of your endowment. And then estate duty. So while you get the money, or the beneficiaries inherit the money immediately because it's administered outside of the estate, the administrator pays the beneficiary immediately. It's still subject to estate duty, but not executor's fees because there's no executor. And the share portfolio and unit trusts subject to estate duty, obviously beyond the exemption. But the real problem is it sits in the estate for years. And the strategy is to, well, how does one avoid having one's investment stuck in an estate on one's death? So let's have a look here. So I just want to summarize what I did for Danny a few months ago, and that is how to invest and circumvent one's estate to get one's money to the recipients, the beneficiaries, as soon as possible. So again, we have beneficiary nominations in retirement funding products. And in the case of discretionary, and we have a beneficiary nomination in the case of an endowment, but we don't have a beneficiary nomination in the case of a share portfolio, a unit trust, money market in the bank. That would ordinarily go into one's estate. So again, things like estate splitting or asset splitting between you and your spouse, where you don't attract donations tax. Much more difficult when you make donations or bequests to non-spouses because of donations tax. And then what's governed by one's will, stuck in one's estate? Well, these are not, but one has to be very careful that one doesn't subject oneself to the tax as per the tax tables that we've just discussed. One only enjoys the benefit if one transfers money to a destination pre or post-retirement funding product. Governed by the will, yes. Governed by the will, no, in the case of an endowment. Can money be paid out in cash? So this is the big trick over here, that if the beneficiaries fully withdraw what they've inherited from the deceased's pre or post-retirement products, if they fully withdraw that, then they're going to land up paying tax as per the tax table. And there are, okay, and there's only one on death, right? The other one applies on resignation. So the more onerous one on resignation and the less onerous one on death, and in the case of resignation as well. And if we go down a little further over here, So estate duty above the exemption, estate duty above the 3.5 or 7 million rand exemption. And then you have just a couple of strategies to split or minimize not just one's estate duty, but more importantly, the time taken for financially dependent beneficiaries to actually receive their money. So we spoke about splitting wealth between spouses, no CGT, no complexity, and the surviving spouse has immediate access to money. So retirement funding products will save on estate duty and transfers to beneficiaries unless you withdraw the money as the beneficiary. Discretionary investments. So let me be really repetitive because we've made this distinction over here between retirement funding, pre-retirement, right, and discretionary pre-retirement. And then we have post-retirement being this vertical line. That's post-retirement and post-retirement discretionary. Okay, so let's go back to the end. And discretionary investments such as shares and unit trusts can be fully withdrawn subject to estate duty, exempt in the case of a spouse. And we need to compare the estate duty rate to the withdrawal rate on retirement funding products. So all I'm saying over here is that estate duty, 20%, 25% beyond threshold, is sometimes less than the tax you would pay on withdrawing money from the deceased's pre or post-retirement funding product. But you have control over that, because as long as you transfer that to a post-retirement pension, you don't pay tax. You only pay tax when you exercise your right to fully withdraw the money. You land up paying more tax than you do estate duty on inheriting money like that. You get it quicker, but you pay more. You may pay more death tax if you like. And then endowments have the advantage of specifying a beneficiary, and that's a huge advantage. You know, the less and less and less efficient our government bureaucracy becomes, the more proactive we need to be in circumventing government institutions. And Danny, that's it. I hope I've addressed the topic thoroughly and accurately.
Thank you again, Herbs. There was a question, I missed it earlier, but what asset class and endowment policy was?
Okay, so here's an important one. Good question. Okay, so we need to differentiate between a product, and a product is a thing like a pension or provident fund, or RA, or a unit trust, an RA, or a living annuity, or an endowment. The product is the wrapper. It determines the tax treatment, favorable or no tax advantage, and restrictions on withdrawal. That's the wrapper, the product. But that doesn't give it value, because I can invest in a pension fund in the Alan Gray Balanced Fund, and I can invest in an endowment or through an endowment in the Alan Gray Balanced Fund. And I can also purchase the Alan Gray Balanced Fund directly. So the product defines the tax treatment and the accessibility to the money, the ease with which the funds can be withdrawn. An endowment is a wrapper. It defines the tax treatment, 30%, or product, if you like. It's not, the performance is determined by the underlying unit trust funds in which you invest. So a common one is, Old Mutual, they tend to be the target of all of this. Their RAs are bloody useless. And Sanlam, their RAs are also bloody useless. But that's, of course, completely inaccurate, because the RA is just the wrapper giving you the tax advantage on the contribution and the fact that interest and capital gains tax are both exempt. What's wrong about this is the underlying fund in which you were placed within the RA. You agree with me? Because that determines performance. So an endowment is not part of any one of the asset classes. It's a wrapper with certain tax favorable tax treatment and a restriction on not making more than 2 withdrawals in the first 5 years. Beyond 5 years, you've got complete access to your money. So within the endowment, you go into funds A, B, C, and D, and depending on how they perform will determine the performance of the endowment, or you can go into funds X, Y, and Z that may give different performance. So I hope I've made the distinction. Let's just go back here. So we know the difference now between the product, defining the tax treatment and ease of withdrawal, and the unit trust fund that determines performance. It could be a money market fund. It could be an offshore balanced fund. It could be, so performance is determined by the unit trust fund, not the product. Okay, I hope that answers the question. Any more?
There's one. What's the difference between a guaranteed annuity and a living annuity?
Yeah, so let's go over that one again. So at the time of retirement, let's simplify things. You've got 2 million rand. You take your 500,000 rand tax-free and you put that into a discretionary investment, or you could go on a cruise. Now, I'm not encouraging you to go on a cruise, but you do something with that 500,000. You must withdraw it because it's now accessible and tax-free. The guaranteed annuity implies that you're surrendering your capital to a life insurance company, and they will provide you with a guaranteed, predetermined income for life. It will not change. In fact, you can purchase it with an escalation option. So it will increase every year, and they will send you a quote and they will say, well, this is the income you're going to get. And you can also ask to include something called a guarantee period. So if you die within the first 10 years, an income will be paid for the first 10 years of the policy, or guarantee period for 20 years. It'll pay an income for 20 years if you're not alive to your beneficiary, typically your spouse. But the unique characteristic about this baby over here is that the income is guaranteed. You know in advance what that income is going to be. What's the disadvantage? That sounds like a win-win-win-win scenario, but it isn't, because on your death, no lump sum of money passes to a beneficiary. At best, you're within the guaranteed period of income, and an income will be paid up until the 20th year since inception or the 10th year to your beneficiary, but they do not inherit a lump sum of money. The other shortcoming of a guaranteed annuity is that the underlying investment return tends to be quite pedestrian, if you like. Life assurers do not speculate with your money. That in nearly every case, there are a couple of variations to this, but the general rule is that they invest your money in the government bond market. And they offer returns typically between 7.5% to 9.5% return. And they take their margin. So based on that 8% or 8.5% margin, they determine what your rate of income is. And in the good old days, an investment partially in equities, in shares, would have given you a better return than purely in bonds. So you would have drawn, or could have drawn, a slightly higher income from a living annuity, given that your return has been higher because you deliberately chose some share market exposure. So, but let's just say for purposes of a guaranteed annuity, you invested in long-term government bonds offering yields of the order of 8%, and your monthly income is determined from the return that the life assurer gets. And everything is predetermined in advance. You cannot compromise your income by investing your money or having your money recklessly invested in a living annuity or drawing excessively. I just want to reinforce that point, that there's a dual responsibility in a living annuity. It works great when your average annual growth rate is 9 to 10% and you're drawing 5% or 6%, because now rate of growth every year is consistently more than rate of depletion. And on your death, you could have more money than you started with. That money then is bequeathed to your beneficiaries. But what happens when the model falls short, as I mentioned earlier? You don't get 8 or 9%, you get 2%. And you don't draw a maximum of 5%. You draw 17.5%. Now you're running your capital down at an accelerated rate. That's severely detrimental to the kind of income that your living annuity can provide for the rest of your life. So there's no element of certainty that the guaranteed annuity provides.
Okay, I don't know if there are any more questions. If not, Herb, I really want to thank you for your time and for putting this all together. My head's spinning. I don't know where I stand with all of this, but I'm sure that everybody else understood it perfectly. And just from a housekeeping point of view, we'll be sending out certificates in the next day or so. And thank you everybody for attending. Change to the morning. I don't know what the preference is, if morning or afternoon makes a difference. But Herb, thanks for your time. And as I said, thanks Danny and everybody for attending today. And now you can go back to work.
Thank you.
Suppose, Danny, we can close off.
I don't know, Tony, do you have a question or nothing? I just see you put up your hand in the chat. I don't know if you want me to allow you to talk.
He's muted, so
I don't know. I've allowed him if he wants to. Hi, Tony. Unless that was just a wave hand up to say goodbye. But, all right, I'm going to be closing it now. See if there's no more questions. Oh wait, there's another question in the chat. Now you're saying the afternoon is better. Yeah, that's just to deal with. Also, I think I like the afternoons better. All right, everyone. We'll see next month. We have Jackie in the afternoon. You'll be sending out the notices shortly, and all the best, everyone.
yeah, thanks very much. Bye.